Welcome back to another weekly market video commentary here with David Hefty, CEO of Creed & Wealth. And David, I don't know if you heard, but second quarter annualized gross domestic product or GDP came in negative for two consecutive quarters here in the US. By definition, putting us in what's called a recession.
Sure.
Right? All over the news. And it can often seem scarier than the reality. Walk us a little bit through what it means to learn today that we're in two consecutive quarters of negative GDP growth.
Right. And I think this goes a couple different ways with hardworking Americans, right? They're working hard, they're saving their money. But when I think about recession, it's always scary. You know, they tend to, if they're in the labor force, they tend to they're concerned whether or not their job's secure. If they're retired, then they're really more concerned about maybe their investments. And so for today, one thing we really want to focus on is just on investments. And when we think about the announcement of a recession, it is a lagging indicator, massively, in fact, lagging indicator when it comes to investments.
Yeah, right. Activity that started to happen or slow down 6 months ago. So what's funny is as we tie that to investments, one of the things that, the investment team here is really in tune with is, okay, great. How are capital markets impacted by the recessionary announcement? And what we see and what the data here, we're going to release our research data here through the link of this video, indicates that 6-month period as we get near that recession before the official announcement, it tends to be often the bottom of capital markets.
Well, and that's the thing, Edison. I mean, you go back through the 3 years leading up to 2022, the S&P 500 is up roughly 80, let's call it 85%. And then as we go into this year, we see the market pull back, breaching that magical 20%, right? Yeah. So that way it's an official bear. Can't call it the headline can't say a bear unless it breaches the 20.
Right.
It breaches it. But what was it? The last few weeks here, we've already started to see the market recover.
Tremendous. Yeah. July was actually one of the best months since mid 2020, right? That tremendous volatility we saw. And it's funny you mentioned that because in addition to that GDP data, we also got personal income, personal spending, and some labor market data, none of which is starting to suggest a sustained downside in economic activity. Which kind of supports the research you're going to see on the market side and the fact that at the onset of an announcement, David, since post-World War II recessionary data, the market has already usually troughed prior to that official announcement.
And again, we don't have a crystal ball, but it does look like this particular recessionary announcement, the way the market's behaving, it looks like it's fallen right in line with a typical post-World War II recession. Yeah. And that's what I love about your guys' research. It's a nice, easy to understand photo. That high school economics class that most people took. That's about all you need to really understand what this photo means. And then again, we just want to make sure all of our clients, those that are not clients, those that have questions about the markets, make sure they understand then how it impacts them personally.
Yeah.
And so the other side of this coin is to make sure that any questions that an investor has, make sure they speak with their financial advisor about this chart specifically, ask those questions if they have them, and then most importantly, make sure they are personally positioned well with their unique circumstances. Where we are in the cycle that we're in right now.
Yeah, I think incorporating them in that planning phase as well is critical.
Oh, absolutely, it's critical.
Because I think from this piece, the biggest takeaway is equity market participation at the current environment is something to want to favor even more, not something to be afraid of, because over the next 12, 18, 24 months, this announcement may be obsolete.
Oh, absolutely. I mean, so this basically what you're saying, right? This could still be a great time, a great opportunity for some investors to really take advantage of the situation and to make a little extra money if possible. While others, maybe it's just a good time just to hold still with current plan and let it keep working. I mean, again, case by case, which is why our advisors do a phenomenal job working with all the clients on these questions.
On that note, thank you very much. Take a look at our research piece and look forward to connecting with you.